Imagine standing at the precipice of your financial future, holding exactly $50,000 in your hands, and facing a choice that will dictate not just your ultimate net worth, but the very quality of your daily life, your stress levels, your weekends, and your freedom for the next 2 decades. This is the ultimate crossroads where the intoxicating, socially celebrated allure of tangible bricks and mortar collides violently with the silent, invisible, yet mathematically unstoppable force of compound interest in the global equities market. Two individuals, whom we shall call Ethan and Leo, find themselves at this exact juncture, sharing identical starting lines in the race toward financial independence, both earning a respectable $55,000 a year, living in the exact same city, sharing the same age, and possessing the exact same $50,000 nest egg. Yet they are about to diverge onto two drastically different paths that expose the massive, often deliberately hidden blind spots of modern wealth-building advice. Ethan, seduced by the incredibly powerful narrative of real estate, decides to deploy his entire $50,000 as a 20% down payment on a modest three-bedroom rental property situated in a solidly decent working-class neighborhood, locking in a substantial $250,000 asset with the immense power of bank leverage by taking out a 30-year mortgage at a standard 7% interest rate, which saddles him with a monthly mortgage obligation of approximately $1,330. Almost immediately, he secures a seemingly reliable tenant who eagerly signs a lease to pay $1,800 a month in rent, a triumph that makes Ethan feel like an absolute financial genius because, on a simple napkin calculation, he is netting a gorgeous $470 a month in pure profit before he has even factored in the long-term appreciation of the home or the tax benefits he will soon claim. Meanwhile, Leo takes an entirely different, incredibly unglamorous approach by taking his identical $50,000 and quietly dropping it into a broad, highly diversified total stock market index fund, choosing a path utterly devoid of leverage, physical keys, midnight maintenance emergencies, or tangible assets he can point to, and he simply sets up an automatic, emotionless monthly contribution of $300, essentially putting his financial future on autopilot and refusing to check the balance. The immediate psychological divergence between the two men is absolutely staggering. Ethan instantly becomes the center of attention at every dinner party and backyard barbecue, regaling his friends with tales of his new property, feeling the immense pride of ownership every single time he drives past the house, basking in the social proof that comes with being a bona fide landlord, and happily writing off mortgage interest and building depreciation on his annual tax returns to legally shave thousands of dollars off his tax liability. Leo, on the other hand, experiences absolutely zero thrill, zero social validation, and zero cocktail party anecdotes, because when his colleagues inquire about his investment strategy, his entirely truthful answer of investing in index funds is met with polite nods and immediate subject changes, leaving him to log into his digital brokerage account perhaps once a quarter only to watch a pixelated number fluctuate slightly up and down in a way that feels profoundly detached from reality. However, as the first 3 years unfold, the brutal realities of Ethan's supposedly brilliant cash-flowing asset begin to emerge from the shadows of his initial optimism, drastically eroding that beautiful $470 monthly profit margin as the insidious, unglamorous costs of property ownership begin to relentlessly drain his bank account. While Ethan has proudly collected roughly $64,800 in gross rent over this 36-month period, and successfully paid out $47,880 to the bank for his mortgage, leaving him with an apparent $16,920 in gross cash flow, this seemingly robust number completely evaporates when confronted with the harsh, unavoidable expenses of the physical world. He is immediately hit with $3,000 a year in inescapable property taxes and another $1,500 annually for landlord insurance, but the real financial hemorrhaging occurs when he is forced to drop $1,200 to replace a catastrophic water heater failure, shell out another $2,008. $100 to patch a sudden damaging roof leak and endure a painfully expensive 1-month vacancy period between tenants that, instantly vaporizes $1,800 in anticipated rental income while simultaneously costing him an additional $600 in unavoidable cleaning and relisting fees. Because Ethan is desperately trying to protect his rapidly shrinking margins, he chooses to act as his own property manager, a decision that essentially forces him into a stressful, unpaid part-time job that demands his attention via frantic text messages at 10 o'clock at night, forces him to sacrifice his precious Saturday mornings to host awkward property showings, and requires him to frantically coordinate plumbers and electricians during his incredibly brief lunch breaks at his primary job. When Ethan finally sits down and runs the actual unvarnished net cash flow math, after 36 months of relentless hustle, he discovers that his real profit is hovering somewhere between a meager $2,000 and $4,000, a staggering disappointment compared to the nearly $17,000 he originally modeled on that napkin, and this paltry sum completely fails to compensate him for the hundreds of hours of personal labor, anxiety, and sweat equity he has poured into the physical structure. In stark contrast, Leo has spent those exact same 3 years doing absolutely nothing but allowing his automated system to funnel an additional $10,800 into his portfolio alongside his original $50,000, and thanks to a historically average 10% annual return in the equities market, his completely passive account has quietly swelled to approximately $76,000 without requiring a single phone call, without demanding a single weekend repair, and without causing a single moment of tenant-induced stress. Yet, despite the exhausting physical and financial toll, Ethan still holds one massive structural advantage that Leo simply cannot replicate in the stock market without taking on catastrophic margin risk: the incredible wealth-accelerating power of leverage. Because Ethan's $250,000 property has been steadily appreciating at a historically normal rate of 3 to 4% per year, pushing its total market value to somewhere between $270,000 and $280,000. This seemingly modest percentage increase, when applied to a highly leveraged $250,000 asset, means that Ethan's actual equity, the critical difference between the new, higher value of the home and the slowly amortizing balance he still owes the bank, has exploded to roughly $55,000 to $65,000, proving that while cash flow in real estate is often a brilliant illusion, the massive wealth generated by using the bank's money to capture appreciation is very, very real. As the timeline stretches toward the 5-year mark, Ethan finds himself deeply entrenched in the gritty, unromantic trenches of professional landlording, having churned through his third set of tenants, swallowed the bitterly expensive pill of an $8,500 complete roof replacement, navigated a horrifying $1,400 plumbing emergency that threatened to flood the downstairs, and endured yet another agonizingly empty month of zero income, forcing him to aggressively raise the rent to $1,950 just to keep pace with his simultaneously skyrocketing property taxes and insurance premiums. His actual cash-on-cash return, representing the true physical dollars he gets to put in his pocket relative to the massive initial capital he risked, stabilizes at a highly sobering 3 to 5% after all real-world expenses are rigorously accounted for, which is certainly not a terrible financial outcome, but it is a far cry from the wildly inflated 15 to 20% returns he enthusiastically boasted about to his friends when he first bought the place. Meanwhile, as year 7 approaches, Leo's relentlessly boring, utterly passive strategy begins to reveal the terrifyingly beautiful mathematical magic of compounding, as his portfolio balloons from its original $50,000 to a staggering $135,000 to $150,000, a massive acceleration driven not by his modest $300 monthly contributions, but by the sheer, undeniable fact that the gains on his previous gains are now generating more new wealth every single year than the fresh capital he is depositing. This represents the fundamental divergence in their wealth-building physics. Ethan's wealth is undeniably growing, but it is growing in a highly linear fashion that is constantly dragged down by heavy physical expenses, structural decay, and the inescapable requirement of his ongoing personal labor, whereas Leo's wealth is growing along an exponential curve, incredibly agonizing and slow for the first half-decade, but rapidly accelerating into a massive snowball that effortlessly creates money out of thin air. By the time they hit the 10-year milestone, the financial scorecards are surprisingly neck and neck, with Ethan's modest rental property now commanding a market value of roughly $335,000 to $350,000, and his diligently paid down mortgage balance sitting at around $166,000, leaving him with an incredibly impressive equity pile of approximately $170,000 to $184,000. However, to achieve this leveraged miracle, Ethan had to continuously inject fresh capital into the asset, meaning his total out-of-pocket expenses for massive repairs, inevitable vacancies, capital expenditures, taxes, and insurance over that decade pushed his true cost basis $20,000 to $35,000 beyond his initial down payment, not to mention the literally hundreds of unrecoverable hours he sacrificed to keep the operation running. Leo, arriving at this exact same 10-year juncture, stares at a brokerage balance of roughly $165,000 to $180,000, having contributed only his initial $50,000 plus exactly $36,000 in slow, automated monthly drips, meaning nearly half of his entire net worth is pure, untaxed, frictionless compound growth that required absolutely zero sacrifice of his personal time, zero debt accumulation, and zero exposure to the localized single zip code risk that Ethan is heavily concentrated in. Fast forward to the monumental 20-year mark, and the grand finale of this financial marathon fully exposes the massive trade-offs required by both asset classes, as Ethan's fully mature property is now worth an estimated $450,000 to $500,000. His mortgage is either completely vanquished or barely a blip on his radar, and his pure equity stands triumphantly between $400,000 and $500,000. Yet, when Ethan strictly audits 2 full decades of operations, accounting for every single replaced appliance, every month of lost rent, every tax hike, every insurance premium bump, and at least one massive, unavoidable, full-scale interior renovation required to keep the property competitive, his total net cash flow profit for 20 years of labor might only hover between $40,000 and $80,000 above his total lifetime expenditures. Conversely, Leo's entirely hands-off portfolio, assuming it maintained that historical 10% average return, has organically exploded into a staggering $420,000 to $460,000 empire, built upon a total out-of-pocket contribution of just $122,000, meaning an unbelievable $300,000 of his net worth is pure, unadulterated compounding magic that materialized without a single late-night phone call, without a single eviction notice, and without a single dollar of borrowed money. At this 20-year finish line, their overall net worths are remarkably comparable, both sitting comfortably in that $500,000 ballpark, but the existential journey they took to arrive there could not be more diametrically opposed, because Ethan explicitly traded his time, his peace of mind, his liquidity, and his risk tolerance to aggressively work for his wealth, whereas Leo traded the thrill of leverage and the comfort of tangible assets to patiently wait for his wealth, enduring the brutal psychological warfare of market volatility in exchange for ultimate personal freedom. Furthermore, the true scalability of these 2 distinct paths becomes terrifyingly obvious when you consider that if Leo simply decided to increase his automatic monthly investment by a mere $200, bumping it to $500 a month, the incredibly multiplied effect of continuous compounding would have catapulted his final 20-year portfolio value to somewhere between $550,000 and $600,000, with absolutely zero extra physical effort required on his part. In the real estate realm, if Ethan wanted to significantly increase his wealth trajectory, he could not simply increase a digital contribution. He would be absolutely forced to go out and purchase a second physical property, completely taking on a brand new massive mortgage, doubling his localized market risk, and simultaneously doubling the heavy burden of his unpaid, highly stressful part-time property management job. Of course, heavily criticizing the hidden burdens of real estate without acknowledging the utterly terrifying drawbacks of the stock market would be intellectually dishonest and fall right into the trap of biased financial influencers, because Leo's journey was definitively not a smooth, anxiety-free elevator ride to the top, It was a psychological roller coaster that required him to violently suppress his natural human instincts during catastrophic global economic meltdowns. Volatility is an absolute wealth-destroying monster for those who cannot control their emotions, and when the market violently crashed by nearly 37% during the brutal depths of the 2008 financial crisis, or when it breathtakingly plunged 34% in a matter of a few horrifying weeks during the March 2020 pandemic panic, Leo had to sit there and physically watch tens of thousands of dollars evaporate from his screen in real time. For a normal retail investor, seeing a hard-earned $150,000 portfolio violently plummet to $95,000 is not just a statistical blip on a chart, it is a profoundly gut-wrenching, sleep-depriving experience that mathematically drives the vast majority of amateur investors to panic sell at the absolute bottom, permanently locking in massive, unrecoverable losses right before the inevitable historical recovery takes place. Additionally, Leo's path severely lacks the immediate, highly comforting dopamine hit of tangible monthly cash flow, because unlike Ethan's reliable stream of rent checks that can actually be used to buy groceries or pay utility bills, index funds provide a ridiculously microscopic dividend yield of maybe 1.5 to 2%, meaning a massive $150,000 portfolio might only kick off a pathetic $200 a month in actual distributable cash, which absolutely cannot replace a working salary or fund early retirement on its own. The stock market completely denies its participants the magical wealth-accelerating steroid of bank leverage, because Leo was forced to use his $50,000 to merely control $50,000 worth of corporate equities, whereas Ethan was able to brilliantly wield that exact same $50,000 to totally control a $250,000 physical asset, a massive 5-to-1 leverage ratio that serves as the primary, mathematically undisputed reason why physical real estate has historically minted significantly more self-made millionaires than traditional stock market investing. Real estate also operates under a completely different, vastly superior set of governmental tax laws, famously allowing investors to legally deduct the theoretical, paper-based physical decline of their building structure from their actual taxable income through the incredible magic of depreciation, a perfectly legal and heavily utilized tax shelter that allows landlords to pay virtually zero income tax on their rental profits, even as the underlying property actively skyrockets in actual market value, a superpower stock investors are entirely denied. Therefore, it becomes entirely clear that real estate absolutely dominates and undeniably wins in highly specific, mathematically favorable environments where the rent-to-price ratio is exceptionally strong, meaning the gross monthly rent collected naturally equals at least 0.8 to 1 full percent of the total purchase price, practically guaranteeing that the fundamental cash flow math works heavily in the investor's favor from the very first day of closing. Furthermore, if an individual is fully prepared to ruthlessly treat their real estate portfolio not as a casual romanticized side hustle, but as a rigid, highly disciplined operational business, meticulously screening prospective tenants with forensic precision, aggressively budgeting a strict percentage of income for inevitable capital expenditures, and building highly automated, foolproof management systems, their leveraged financial returns can absolutely obliterate the historical averages of the stock market. This is incredibly true for those who bravely utilize aggressive, highly effective strategies like house hacking, where an investor consciously chooses to live in one unit of a multifamily property while aggressively renting out the remaining units to desperate tenants, effectively reducing their own personal living expenses to absolute zero while simultaneously building massive, heavily leveraged equity, a spectacularly efficient wealth-building maneuver that simply does not exist in the digital realm of stock trading. Additionally, the profoundly powerful governmental loophole known as the 1031 exchange allows savvy real estate operators to continuously sell highly appreciated properties and legally defer 100% of their massive capital gains taxes by immediately rolling those massive profits into acquiring even larger, more expensive buildings, allowing them to essentially grow a massive multi-million-dollar real estate empire completely tax-free in a way that stock investors absolutely cannot ever replicate without hiding behind restrictive, heavily penalized retirement accounts. Ultimately, physical real estate is absolutely not a bad, defective, or inherently dangerous investment vehicle. It is simply the most wildly misunderstood, heavily romanticized, and improperly calculated asset class on the planet, heavily promoted by incredibly biased individuals who flatly refuse to acknowledge the massive physical, emotional, and temporal costs required to extract its undeniable wealth. Both Ethan and Leo confidently walked away from their initial $50,000 decision entirely convinced that they had outsmarted the system and secured the smartest possible path to immense wealth, with Ethan totally believing that heavily leveraged physical dirt was the only historically proven avenue to building a lasting legacy, while Leo fundamentally trusted that the unstoppable, automated efficiency of the global capital markets would silently do all the heavy lifting for him. The profound tragedy is that absolutely neither of them took the necessary, grueling time to comprehensively sit down with a blank spreadsheet and rigorously map out exactly what their chosen path would truly cost them over a grueling 10 or 20-year horizon, not just in raw, quantifiable dollars and cents, but in the equally critical, completely unrecoverable currencies of personal time, emotional stress, localized risk concentration, and absolute liquidity. The ultimate financial trap that destroys so many aspiring millionaires is not the inherent nature of physical real estate, nor is it the wild, unpredictable volatility of the global stock market. The true devastating trap is blindly picking either one of these highly complex asset classes, based entirely on a highly edited, sensationalized YouTube video thumbnail, a completely out of context 30-second podcast clip, or a totally unsubstantiated rumor confidently spouted by a historically unsuccessful uncle over a heavy Thanksgiving dinner, all without ever taking the absolute responsibility to rigorously run the full, comprehensive mathematical models based purely on your own unique, localized situation. If you ever find yourself boldly wondering what magical financial alchemy occurs when an incredibly disciplined investor aggressively decides to do both, simultaneously leveraging physical property to capture immense tax benefits while aggressively funneling their excess cash flow into the highly liquid, exponentially compounding engine of the total stock market, you are opening the door to an entirely different, incredibly complex yet terrifyingly powerful conversation that completely shatters and fundamentally changes every single preconceived notion you currently hold about how generational wealth is actually constructed in the modern world. But for now, as you navigate this treacherous landscape of endless financial advice, the very next time a highly confident, incredibly slick individual emphatically looks you in the eye and absolutely guarantees that real estate always decisively wins, or conversely swears that the passive stock market always ultimately prevails, you must aggressively stop them in their tracks and demand the answer to one single, completely non-negotiable question. You must look them dead in the eye and aggressively ask if they actually included absolutely everything in their calculations. Every hidden fee, every lost weekend, every emotional breakdown, every tax advantage, every inflationary adjustment, and every opportunity cost. Because the harsh, undeniable truth of the universe is that the heavily detailed, unromantic answer that meticulously includes absolutely everything is the only legitimate answer that will ever actually matter to your financial survival.